Hello everyone, I'm Elakkiya, working as Assistant Professor in the Department of Management Studies in JJ College of Engineering and Technology. Today I'm going to explain about monetary policy in the Managerial Economics. So monetary policy, it is a set of actions taken by the central bank, which is RBI, to control the money supply in the economy. RBI is responsible for formulating and implementing monetary policy. So monetary policy committee, it is a body within the RBI. It actually consists of six members. Three members will be from RBI. It includes governors, deputy governors, and an officer from RBI. And the other three will be appointed by the RBI, who are all expertise in banking, finance, and economics. This monetary policy committee is held at least four times in a year. So it is actually called as quarterly monetary policy. So objectives of monetary policy will be reducing unemployment, price stabilization, and economic growth. Roles of monetary policy includes rapid economic development, stability in prices, suitable interest rate structure for the economy, and public debt management. Monetary policy is broadly categorized into two types. One is expansionary monetary policy, and the other one is contractionary monetary policy. Expansionary monetary policy aims to stimulate economic growth by increasing money supply, whereas contractionary monetary policy helps to reduce inflation by decreasing the money supply and raising interest rates. So what is the difference between inflation and deflation? Inflation is increasing in the price level of goods and services, whereas deflation is decrease in price level of goods and services. So it both have significant impacts on the economy. So the economy should be stable without inflation and deflation. That's why monetary policy is introduced for maintaining the price level. So, tools of monetary policy. Monetary policy can be categorized into the tools of monetary policy can be categorized into two types. One is quantitative tools, and the other one is qualitative tools. Quantitative tools includes open market operations, repo rate, reverse repo rate, statutory liquidity ratio, cash reserve ratio, marginal standing facility, liquidity adjustment facility, and bank rate. Qualitative tools include moral suasion, margin requirements, and selective credit control. So now we can discuss the quantitative tools. So repo rate, it is the interest rate at which commercial banks borrow money from the central bank. So, for example, commercial banks like state banks, Canara banks, all these, if they borrow money from the central bank, which is RBI, the interest rate will be 5.5 percentage, and it is the opposite of reverse repo rate. That is the interest rate at which central bank borrows money from other commercial bank. It is called as reverse repo rate, and the present reverse repo rate is 3.35 percentage. Always repo rate will be higher than reverse repo rate because these rates will be fixed by RBI. So open market operations, it is the buying and selling of government securities to influence the money supply in the economy. A statutory liquidity ratio, the percentage of deposits that banks maintain in liquid assets. That is, the commercial banks, they maintain the deposits within their own bank. It is called as statutory liquidity ratio, and the current statutory liquidity ratio is 18%. Cash reserve ratio, it is the opposite of statutory liquidity ratio. That is the percentage of banks that the commercial banks have to hold within the central bank. It is called as cash reserve ratio. The current cash reserve ratio is 3%. In statutory liquidity ratio, the banks they have to hold the deposits within their own bank, whereas in cash reserve ratio, the commercial banks have to deposit some percentage to the central bank, which is RBI. So liquidity adjustment facility, it is borrowing money from RBI using repo rate or else lending money to RBI using reverse repo rate. So it includes both repo rate and reverse repo rate. Marginal standing facility, it is provided by RBI overnight. So marginal standing facility is always higher than repo rate because RBI lends money to other commercial banks overnight. So the current marginal standing facility is 5.75 percentage. Bank rate. The interest rate at which commercial banks borrow money from central bank without any collateral, it is called as bank rate. Collateral means security. So the difference between bank rate and repo rate is the central bank, that is RBI, lends money without collateral, it is called as bank rate. And if the central bank lends money with collateral, that is any security, it is called as repo rate. So the qualitative tools includes moral suasion. If the central bank persuades and guides other commercial banks and they influence their lending practices, it is called as moral suasion. And if the central bank influence the amount of credit for specific purposes by setting margin requirements, um, this will come under margin requirements. Selective credit controls includes if the central bank directs the flow of credit to some specific sectors, it is called as selective credit controls. This is how the monetary policy is used to control the money supply in the economy. Thank you. You can share your feedback to this mail ID. Thank you.